All right. Good morning, everybody. We made it to the end of the week. We have another short week next week with Tuesday the 31st. We're going to close early. And Wednesday, January 1st, will be closed completely. So another week like this week, holiday flows, lack of liquidity, short week, messes with the options a little bit. There's been a lot of talk about a Santa Claus rally, which comparing this year to previous years, I mean, we just got started, right? The Santa Claus rally starts after Christmas. But there's a big threat on profit taking. You know, if you want to kick the taxes off into the next year, you wait until the new year before you start taking profit on things. And we've had some exponential moves this year. So really know what you own going into the new year and understanding what a healthy pullback would look like versus an unhealthy pullback. And be ready for some profit taking of size, right? A 50% haircut on some of these plays wouldn't be a surprise at all. Doesn't mean we're headed back into a bear market or anything like that. Just, you know, really be aware that it could get a little violent out there when we do finally get into the new year. Looking at what's going on around the world, Hong Kong is basically flat. Small caps are down the most. So certainly not seeing a continuation in those meme stocks, short squeeze. The NASDAQ is down 0.25%. Everything in the US is down, right? Holding the lower end of this spectrum. And Europe got a little bit of a rally. You know, if we were looking for the US markets to catch a bid from the Europe rally, we're not seeing it yet. Just keep in mind that Europe closes in the middle of our trading day, and a lot of times we see the S&P change behavior after the EU close. So it doesn't hurt to keep your eye on that clock. The clock is one of the best indicators you could ever use. There's a good website. It's called tradinghours.com. It's free. It doesn't cost you anything. You don't even need to log in. And it'll give you markets from around the world, tell you whether or not they're open, whether or not they had a holiday, if they're going to have a holiday, and it tells you what global time frame they're in so that you can monitor them for yourself. What I usually do, because the time zones can get confusing, is on Thinkorswim, I will pick the time zone on the chart that matches the time zone that I want to monitor. Like, say, for an example, Tokyo or Australia. You can set your chart to their time frame, and then you'll see their market open and their market close. And a lot of places close for lunch. I know we don't, but it's just a strange concept, that markets actually shut down for lunch and then open back up again after lunch. Strange stuff. But anyways, this is a free website. It doesn't cost you anything to go here, and it will help you keep track of markets that are open or closed. Because on Thinkorswim it does this, but it never checks to see if they're on holiday or did they really open at all. Maybe it was a banking holiday. Um, so that one's more accurate than Thinkorswim. There's been a lot of talk about inventories and the shipping explosion that's really taken off after Trump got elected. All these talks of tariffs and whether or not he's going to do it. according to everything that's been coming out, companies didn't wait to see if he was going to do it or not. As soon as he got elected, they started boosting their supply chain and really bringing things in, trying to beat the clock and get in under the wire. So that sounds good for shipping and rail and anything that's moving goods and services in the short term, at least. And we're going to get some data today. I don't think this is necessarily what we want to tie it into, but we've got retail inventories and wholesale inventories. And just take a look at those numbers when they come out at 8:30 today. See if they have anything to tell us. Otherwise, by noon today, we are going to have all the data that we're going to get. Anything else will be shock and awe, surprise news that we weren't expecting, and we'll get into the end of the day. It's Friday, so everything that has weekly options has a 0 day today, right? It's like a buffet of things that you could trade that have 0 day opportunity. Just keep in mind these options flows are just horrible right now. The prices are off their mark, wide bid ask spread. And when you do find liquidity, it's in strange places. Names that don't normally get flow are getting some really good flow. It's not going to last, but take it while you can get it. And we got a little bit of risk showing up today. We see Bitcoin up more than 1% this morning. We'll take it. All right. So, um, perspective, this is a 15-minute chart, and this purple line is the 200 period moving average. Always think of the 200 period moving average on any time frame that you're on as the long-term trend line in the sand. So you can see after FOMC when we had that massive drop and then we were under the 200 into the new week, right? Well, Friday we jumped back across it, struggled with it Monday, and we've been holding above that 200 for most of the week. But we're on it now, right? That's the 200 period on a 15-minute chart. Of course, the chart time frame matters, and long-term trend can be as long as your chart time frame. We've been trending for 3 days above this 200 period moving average, so it's obviously a short-term trend. But you can always take that logic and funnel it out into a higher time frame. This is 65 minutes, and you can again see that we're back above the two, but here we're struggling more, right? This is more of crisscrossing back and forth above and below the two, and the two is more flat than it is sloped. The the slope of that 200 period is going to really help you out, whether it's pointed up at a good angle or down at a good angle. You don't want a flat moving average, right? We're not using these for entries or exits. We're just using it as a bias on defining market structure. It's like looking out the window to see if it's raining or not, right? You're not making it rain. You're just looking to see if it's raining. So this moving average isn't telling you to trade. That would be crazy. We're just looking at it to define the health and the strength of the market and where its trend is. It's flat. So we don't have any value on the 65-minute. Put it on a daily and we're still nowhere near that 200. It's a long ways off. So it's all perspective. But in the short term, we do want to stay above that 200 period moving average. Now we can get below it like we did on Monday. We got below it and we came back above it. but that's more of like a reset, right? You go back to the start and then start again. So if this is just a reset, then we will spring off of this, much like we did back here. And then we'll focus on breaking the high of yesterday. That would also be the high of the week. And we would continue our push to the upside. If we don't get back above that line, we'll focus on the low of yesterday and then the low of Tuesday, then the low of Monday. You kind of get the idea, right? The floor pivots are very narrow this morning, and I kind of believe you probably can't see it, so let's try to highlight it a little bit. I keep these lines very light so that they're not bright and heavy and easily distracting. If I hold my mouse there, they kind of highlight a little bit, but we'll just doodle. So this is the top and that is the bottom of the pivots today. You can see it's a very small structure. Yesterday was a little bit bigger, but these are not very wide at all. It won't take very much to get an R2 or an S2, R3, which I don't have showing, but it wouldn't take very much. When you start to broaden things out a little bit, you can see after we've had a big day, these lines can really get spread out. Here's a day not too far back where that was the range of the day. You can see how wide that is. It's a really big range. Compared to today, today's not even 25% of this entire range. So the pivot point itself, the purple line, the floor pivot, can be helpful because it's going to show you where the floor pivot is. But the S and the R's today, they're going to be so narrow and so compressed, they're not going to be valuable to you. Just discount them completely, ignore them because they're too close to the central pivot point. For that central pivot today, yesterday's channel was kind of wide. Today's channel is very narrow. A narrow channel implies that if we do break out, this thing could get legs and really run. It sounds good. We're already at the lower edge. So to break down and really run from the bottom, well, that doesn't take much imagination. To break out and run from the top, we would have to get through the floor pivot, the half back of our own Globex, yesterday's high, and then expand into the ADR half and above and beyond. That's a tall order, right? Today's floor pivot is higher than yesterday's. That's mildly bullish and bias. But price opened above it and then cut below it, and that's mildly bearish. So those two kind of cancel each other out. We are closer to the lower ADR than we are the upper ADR. So kind of implies that, if we break our own Globex low, then we'll come down and we'll test this ADR half, this red line at 60.62. To do that, we would also need to break yesterday's low, which would give us that double bottom bear trap bounce setup. Really beautiful play. Absolutely love it. And that would be our reversal to run back up, test our own half, get through the floor pivot, yesterday's high, and then get up into that 61.21 by the end of the day. The sooner we can get down here and hit this lower edge, the sooner we can get up here and hit that upper edge. Just keep in mind, like I said yesterday, this market doesn't owe us anything. It doesn't owe us a breakout. It doesn't owe us a run. even that narrow channel, which implies if we break out that the breakout could really grow legs, that channel doesn't move price. It's not going to make us break out. It's just saying that if we do break out, it could probably run. So with all the risk on the table, with everybody starting to consider profit taking in the new year, the elevated risk premiums, everything else, we could just chop sideways here into the end of the day, and that's a wrap. If we get that breakout to the upside, we have last week's point of control, 61.32, which is also a cog line, and we have the FOMC liquidity gap. You can find that gap on your own. Just go back on whatever you want to trade to 2 p.m. Wednesday of last week. Mark the open bar, right? The 2 o'clock open bar. That can be a 1 minute bar, 1 hour bar. It doesn't matter. It's 2 o'clock, right? So the new hour. Getting back to that spot would be getting the liquidity gap closed, which is still on the table, by the way. We still haven't done that yet. Otherwise, breaking the low of yesterday breaks the 200 on the 15, begins that transition into a bear market in the short term, right? We're just talking on a 15-minute chart. And then 2 or 3 days of staying under the two if we actually expand away from it. For that downside move, we do have the value area low, 60.18, a little bit of structure there that might help us out. I wouldn't count on it because if we start to get negative, I think it'll snowball. That's worth considering too, right? Now, we have market maker move this morning, which is generally a signal that they are hedging. Don't take that out of context. They're always hedging, right? That's a given. They're always hedging. What we're looking for is additional hedging. Like they didn't have enough and now they're going to add even more to what they were already holding. Volume looks fine at 48. Holiday volumes, I'm surprised to even see that much. So the volatility trigger is right around the 10-day moving average and the 20-day moving average, which is also lining us up with that 15-minute 200 period moving average. They all kind of tie in together. And if we were to go back to that hourly, by the way, it also lines up with like an hourly 50 period moving average, right? It all ties together. And no matter what those time frames are, 60, 65, or 60, 70 is just a significant structural support and it needs to hold. That's the cool thing about multiple time frame analysis and, being able to just randomly choose whatever moving average you want. It'll still tell you 60, 68, 60, 70. It's got a lot of structure. If we break through all of that and the volatility trigger and we get through the ADR half, we've still got 0 gamma. And below that is where things start to get a little nasty. If we're in positive gamma now and we break out, market makers will sell as we rise and they will buy as we fall. That generally keeps us contained and it stops rallies from getting out of control and it stops us from waterfalling to the downside too deeply. But if we get below the 0 gamma line, now we're in negative gamma and they will sell as we fall and they will buy as we rise, which can make those kind of days travel a lot farther than you would expect. Those would be the days where we keep going 1.5%, 2% moves and you think it can't go any farther and then it goes another 0.25% because the market makers are selling into that fall or buying into that rally. Below the zero gamma, we've got the 3-week, and then the final line in the sand, 6032, which is a cog line, but it's also the full ADR to the downside. I think it would take something pretty negative at this point today to drop us that far down. So if you don't have Thinkorswim and you want to keep track of the market maker move, it's not a big deal. The market maker move is something that Tom Sosnoff and his team developed years ago. They just made it up, right? How's that for fun? So you take the front contract and its implied volatility right there, which is 9.4, and you compare it to the next contract out, which is 8.86. If the higher number is the front number, you've got a market maker move. That's it. Now, there's articles that you can read online published by Schwab and or TD Ameritrade, because TD Ameritrade had a good article on their ticker tape website. Then they sold this whole thing to Schwab, and Schwab kind of made a summary page. And they'll talk about earnings or new drug trials, things that can mess with the implied volatility. They never talk about the futures in all of that. But that doesn't mean we can't use it for futures. What it's calculating, where this number even comes from, this is an implied volatility average. And to get that average, they look at all of the options that are out of the money in that series. So this is the 0 day, it's today, it's Friday. We would bring in implied volatility, and it would calculate the average of all of these out of the money options and all of these out of the money options. Trading heavily changes the implied volatility within those strikes itself. So if they're coming in with thousands of contracts out of the money, that jacks up the implied volatility at that strike, and then it starts to bleed into the other strikes around it, and it increases the implied volatility. And they'll do that when they're hedging in the near term, very near term, right? Because it's going to expire today. They just want today's protection. That's where it all comes from. Now, if we were looking at equities, you'll see that sort of behavior on, earnings days and that sort of stuff, which is what the articles were getting into. So we can see that they're hedging. The market maker move, what we do with that number, which at the moment says 10 points, is we would look at the entire range of the day, and we would add 10 points to the upside and 10 points to the downside for how far we could move on a given day. So for us, the yellow lines, the ADRs, it says 61.52. We would just add the 10 points to that, 61.62. And for the bottom, 60.32, that would be 60.22. Simple enough, right? Nothing to it. If we break that 60.32, we've got 60.11 cog line, 6,000, 59.92 cog line, and then the 10-week moving average and the put wall. I know, I can hear it. You're already saying, why are you looking down at 59.50? We're at, 60.70. We're not going there today. No, I agree. I don't think we're going there today. But make no mistake about it, we could go there. The market has lock limits for a reason. If we fall more than 7%, it will trigger those lock limits for 15 minutes. They'll reopen. And if we fall another X amount, they'll lock them again. And we've done it before. So calculate what a 7% move looks like in the S&P, because we've done that. Did it during COVID. Or even just your standard, oh gosh, day where we go 2.5% or 3%. Yeah, we do those more often than you think. So no, I don't think we're going to 59.50, but it's a low volume day, end of the year. Shenanigans can happen. It doesn't take much of a spark to kick things off, and we could get to 59.50 by the end of the day. No problem. Tail risk exists right? As a concept for a reason. 10-day, 30-minute volume profile. We still have that point of control overhead. It hasn't moved yet. It very likely won't move into, say, Tuesday. Maybe by Tuesday afternoon, we'll see it adjust. The thing is, where's it going to go, right? There's not a whole lot to it. So if we drop back down and we elevate some of this structure down here, then it could be down here. I have a sneaky suspicion it's going to show up around that 6100 area. So our new point of control will be here. The profile really isn't going to shrink all that much. We'll lose, 40 points off the top next week, and then it'll look a bit more like this with a new point of control to it. And that's if we don't break out and expand back up. There's always that little line in the sand, right? The little asterisk that says unless. So if we get back above 6100, we can keep the shape of the chart that we have now. But I still don't see that point of control surviving up there for another week. That will remove resistance from overhead. All right, we got a new VPOC from yesterday. Bring this up to the point of control. That's something looked wrong there. All right, 6099.5, basically 6100. We already knew that as a round number that was going to be a difficult level to get through. Now it's also even more difficult to get through because that's the point of control of yesterday. We don't want to inherently just start off with the idea that it's support or resistance because that's a false premise, right? It just leads you in the wrong direction. But you do want to recognize that that's where the heaviest amount of trading took place yesterday. It's the greatest amount of volume. Buyer's remorse, trader's remorse, the idea that there's unfinished business there. You could always just consider it from your own perspective. If you got in yesterday at 6100 and you find yourself there back again at 10 o'clock this morning, what would you do with your trade? Reevaluate your position at the very least. So 6100 could be more difficult to get through than we were first aware of, since it's also yesterday's point of control. It's worth noticing this much liquidity at the open in that first hour. When they talk about the IB, the initial balance, that's between 6 and 7 p.m. if you're focused on futures. And while that's not the most volume of yesterday or, today's profile, we didn't spend a whole lot of time there. We spent hours at this next level. And, we got in that first hour was 1/3 the amount of what we got in that next 4 hours, 5. Could make it more difficult to get through. Now, it is worth noting that today's point of control is down here with us, and so far structure is holding there. If we break down out away from it from below, farther than the extension that we've already got here to the downside, we could really expand. Otherwise, we would look for reciprocation. We went this far above it. We expect to go that far at least below it and still be in a magnetized state where this entire thing is a zone. We could just sit in there and chop. We do have next week's range, but it's not set in stone yet. So this is a bit of a preview. It's just giving us a glimpse of what next week's range could look like. It's not set in stone and it won't be until after the close today, but we can still compare what we have the preview to what we already had this week. Two things give us the math for this range. One is time, and the other is volatility. This current week was a short week. Next week is also a short week, so they each have the same amount of time. The only difference would be volatility. Now, at first glance, when we see it's more narrow, we would think, oh, volatility is less for next week. That must be a good thing. Not necessarily. Big events cause volatility suppression until the event gets here. FOMC, CPI, non-farm payrolls. Something big is on the horizon, and it's causing the market to contract, the market's volatility. Let's be more specific there. It's causing the market's volatility to contract before this event. We'll take a look at it again on Monday and see how much this has changed. So we'll just keep that box there and look at it again next week. One more thing about these boxes, we are inside our own range. We close inside this range. Statistically, we're supposed to do it 70% of the time. So staying underneath 6,100 is what the statistics say that we should do. We should close underneath it today. That doesn't mean we will, right? It's just statistics. So we're at the 10-day, no surprise. This is not negative per se. It's like hooking your car up to the charger. You got to get juice if you're going to travel. So this is building up energy. It's getting juice. That's not a directional tell. It's not a directional bias. It's just telling us this market is getting ready to make a move. What direction is going to have to come from, other resources. And we're still more than 1.5% away from the 10-week. It's important that we stay at least 0.75% away from that 10-week, or it will draw us into it like a magnet. We got near it, got our reset earlier in the month. Now we've started to move away from it. We don't want to drop back down again, or we're likely to revisit it. Could undercut it at that point. Maybe get a little more, thrust, inertia. That's the word we're looking for, to get back up and get through and get above 2%. Still, the fact that we are above the 10 is healthy. Bias is still bullish. But these waves have continued to get lower and lower. Sure, we have an outlier, something like that kind of throws off the trend. Otherwise, it has been gradually swinging up on the upside less and less each time. The trend is slowing down. The momentum is slowing down. So China is down this morning. Bonds, gold miners. Really, that's it for our 0.5% guideline, right? It needs to be down at least that much. For things that are up, we've got Bitcoin, and that's it. The Mag 7 negative volume is up, which I know that can sound confusing. The Mag 7 is not up. The negative volume in the Mag 7 is up. Nat gas and Bitcoin and crude. That's not what you want a rally based on. And that's what we have this morning leading. Oil and gas exploration, crude, Bitcoin, and nat gas. This is not what can sustain a rally. We need, uh, chips, financials, technology, consumer discretionary, communications. So if you want a rally today in the S&P and the Nasdaq, I would look for those sectors to start moving in the right direction, and or I would look for 0-day flows to specifically move the S&P and the Nasdaq by themselves. And that would make sense, right? They just come in and hit the calls or the puts and just drive the S&P and the Nasdaq through the options structure. It has to be one or the other. Otherwise, we get back to what moves a market. Looking at what's down, silver is the most down, then the China constituents through the KWEB, bonds, and there's our semiconductors. We would need them down 0.5%, but they're certainly not moving in the right direction. If we're looking to be saved by the chips, we would need that turnaround. We're not getting it at this point. Same thing with financials. We would need financials, consumer discretionary. We don't have any of those helping us out. So the tide needs in those sectors, or we got to get the options flow. These are the 3 sectors across the top. They can be swapped out, right? With tech, you can put in SMH or communications. It's still tech, right? Just more nuanced versions of tech. Consumer discretionary and financials. We got to have those 3 today, at least 2 of them. And for that rising tide scenario, this is a daily chart that we're looking at, and all of the sectors in the last 5 days have this blue label showing they're all positive now. Granted, Staples is basically flat, but it's flat instead of being negative like it was to start the week. Thing is, like I pointed out, most of these are in a dead cat bounce. So sure, they're rallying to the upside. Very likely they're just rallying into resistance, and then they're going to flip over and continue the drive lower. Whereas, with tech, it's back up to that high or near it. And consumer discretionary, it's got that scoop pattern, so it's headed back up into the 240 area. And financials, well, they're going to be kicking off earnings soon, and they're not looking too good fighting the 50. So it's what I got for you guys. Be careful, be safe. It's the end of the week. Short week next week. I'll see y'all Monday.